The most highly anticipated Fed week is finally here. And the question everyone's asking is, if the Fed cuts their Fed rate, does that mean mortgage rates will follow? And here's why that matters so much. Because this decision could shape whether buyers can lock in a payment that they can actually live with or get priced out all over again. But the truth of the matter is, it's just not that simple. And let's break down the dynamics so that you can see the opportunity in today's uncertainty and not get stuck in fear by the headlines. And mortgage rates just fell to 6.27% in the last 10 days. That's the lowest that we had seen in nearly a year. And not because the Fed acted. Rates dropped because bond yields pulled back as investors bet on a Fed rate cut. As a result, mortgage applications surged last week, mortgage demand hitting a 3-year high, with the refinances making up nearly 50% of it. And that tells me that homeowners who locked in at 7% or 8% are jumping in to save hundreds of dollars every single month. The other half, buyers testing the waters. Not to be a town crier here, but if you look at the rate movement that we've seen in 2025, the last 2 times that rates dipped, the relief given lasted about 2 weeks total. Both of those times reversing by either a hotter than expected jobs report or sticky inflation. And then the 2 times right before that, the rate drop only lasted a singular day. So I don't want to put any bad juju out there, but I'm looking at this past year as well as what happened in September 2024, and it's eerily similar. Rates fell before Fed week in September, only to snap back above 7.125 within weeks, and then climbing to 7.25 by January. While this week's Fed cut is one of the most highly anticipated since last year, what really matters is Powell's tone on Wednesday. If at the press conference he signals more cuts ahead, the markets are going to lean in. They're going to celebrate. Bond yields will hold down and rates will stay low. If he hedges, spreads will widen. Mortgage rates will rise, even with a rate cut. Why does Powell's tone matter so much? Because the markets trade the future. Investors have already anticipated the cut expected for this month. From here, they're interpreting the path forward. If Powell leans in and he says that this is the start of a cycle, the markets are going to rally. Mortgage-backed securities will tighten and the rates will dip further. If instead he stands back and he stresses caution, like this could be the one and done, or we need to further wait and see, investors are going to pull back. And this is where we've seen mortgage rates rise, even in the face of Fed cuts. There's another under-the-radar lever that we need to watch, as the Fed doesn't just set the short-term rates. They can also buy and sell long-term treasuries and mortgage-backed securities. When they step in and buy, now let's think about this in real estate terms, when more buyers come into the market and demand goes up, what happens? Prices go up. That's just basic supply and demand economics. In the case of bonds now, when prices go up, yields or bond rates go down. And mortgage rates, well, they follow. The Fed did this aggressively during the pandemic, launching an open-ended quantitative easing program in March of 2020, which, as we all remember, drove rates into the 2s. In June of 2022, they reversed it, and they started quantitative tightening, reducing their balance sheet by not reinvesting all the proceeds from their maturing securities. If they even signal the possibility of buying again, it will calm risk spreads, further lowering rates. That's why this week isn't just about the cut. It's about the roadmap Powell paints and the tools he hints at using. And of course, this season also brings an added wild card that investors are keeping a very close eye on, which is the Fed's ability to maintain its independence from political pressure. Losing that independence will have many investors hesitant to invest in long-term bonds, widening risk premiums and adversely affecting our mortgage rates. We've all watched as the White House has publicly pushed for a bigger rate cut for political reasons, while also testing their legal limits by shuffling Fed governors. This week, Stephen Moran was confirmed to the Federal Reserve Board while also keeping his White House job. Now, that feels a little bit like a conflict of interest to me. Meanwhile, also this week, the appeals court ruled in favor of Lisa Cook keeping her job. Of course, the question is, should she? With both of these governors voting at this week's Fed meeting, the markets will parse any hint that the Fed is bending or resisting pressure. Let's parlay this back over to real estate. Buyers today are exhausted. Volatility, affordability pressures, and uncertainty makes waiting this out and sitting on the sidelines such a better answer. However, the psychology we are seeing anytime rates dip, even modestly, buyer demand surges. Rates dropped starting September 4th, and the mortgage purchase applications jumped immediately by 6%. I mean, on a $600,000 loan, a 1% drop saves $400 a month. I mean, that's nearly $5,000 a year. That's real money. And that's why applications just spiked. When buyer competition rises, multiple offers spark bidding wars that push home prices higher. I personally saw that with some of our buyers over the last 2 weekends. So as a potential buyer, the question is not, will rates go lower? The question really is, should I personally act before everyone else does? Because once people feel stability, multiple offers on the right homes will come right back. Personally, as an investor and a buyer in today's market, I'm looking at increased inventories, giving buyers leverage we haven't seen in years. I mean, 14 states now have more homes for sale than before the pandemic. Denver, active listings are up 22% year over year, and 58% of homes cut their asking price last month. Builders are sitting on excess inventory. As of July, it would take 9 months to clear all the new homes at today's sales pace. I am also seeing more and more sellers willing to cover closing costs or pay for permanent rate buydowns and make concessions they wouldn't even have considered 2 years ago. Yet this could only last until next spring if rates continue their downward trend, even if it's slowly, as lower rates will bring more buyers off the sidelines and absorb that excess inventory. Markets could then return to a more balanced, less seller contribution environment. Having said all of that, lower interest rates from here are not guaranteed. Inflation's still sticky, with a headline CPI increasing for the 5th straight month in a row, 2.9% year over year this past week. And core CPI, well, that hit 3.1%, its hottest in 4 months. If inflation continues to run higher, bond yields will rise as investors require a greater hedge against inflation. And mortgage rates will, of course, follow. On the other hand, jobs are weakening. We are seeing that as that is the main reason that the Feds can actually cut this month. August only added 22,000 jobs. That was a third of what was expected, and revisions erase months of growth. Uncertainty in the jobs market kills consumer confidence, as buyers won't make big moves if they're worried about their personal job security. That's why Powell's press conference this week is pivotal. His tone and directional clues will tell us if rates will hold steady or snap back. So here's my takeaway. Lower mortgage rates could heat up the housing market this fall and into next spring, but only if the Fed, inflation, and investor psychology line up. What's certain right now is this: rates are at their lowest they've been in almost a year. Inventory is still building, and sellers are negotiating. You don't need to time the Fed to win in this market. You need to act when the opportunity is in front of you. Let's run your numbers and see what buying today looks like, and if not now, building a plan for when. Because ultimately, hesitation is expensive. If this gives you clarity, do me a favor and hit that like and subscribe, and share this with someone you know who's sitting on the sidelines thinking the Fed rate equals mortgage rates. And I do this every week because I want to put you in a position of not guessing and starting to build real wealth. This is Nicole Rueth, and I'll see you next week.